Netflix is scheduled to report third quarter earnings results after the stock markets close on October 21st, 2025. And investors are asking me if they should buy Netflix stock before the company announces those earnings. Because as you might already know, earnings results after the earnings results tends to be a volatile time for a stock price where it could jump by 20, 30, 40, 50% or fall by the same amounts or even more. So investors like to know that so they can time their purchase either before or after. Now, while I don't condone trying to time the market, I understand there are many investors that are grappling with that question. So I will answer that question here in this video and share with you what I think you should be looking out for from the company in its upcoming earnings release. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now. So on July 17th, 2025, when Netflix last updated investors, they beat and raised their guidance for the year. They now forecast 2025 revenue in the range of 44.8 to 45.2 billion. That's up from their previous estimate of 44 billion at the midpoint. So the midpoint of the guidance was increased by roughly 1 billion. The company's operating margin is also expected to come in better than expected at 29.5% versus 29% previously estimated for 2025. Zooming out a little bit, the fact that Netflix is already generating operating profit margins around 30% is remarkable. It's something that many investors in the media industry, in the content industry, were concerned about before this transition fully took momentum, right? If you're thinking about, let's say, 2017, right, and we're looking at the dynamics around streaming content versus cable and satellite subscriptions, the biggest fear investors had was if we switch to this fully streaming model, that the operating margins industry wide would be much lower. And there are several reasons for that. One of which is that it's so much easier to cancel your streaming subscription versus, when you had a cable, if you remember, if some of you had a cable or direct TV subscription, you had these complicated contracts where you had to sign a 2-year deal in order to get them to come over and install and get you on a monthly plan, which then increases after a year or after 2 years. You sign these very complicated contracts. And in fact, that's one of the reasons why people are so much more interested in streaming content versus, a cable or satellite subscription is because it's so much easier. One click and you're online. One click and you have a subscription versus, when you want a direct TV or cable, you got to have an installer come over. That could take hours and the cost is much higher, much more difficult to cancel. All of those structural advantages in streaming versus the cable and satellite have benefited this industry overall. And those tailwinds are forever lasting. They are never going to change. It's always going to be more convenient to stream content versus a satellite or cable subscription because you need to be at home or in your office to access that cable or satellite subscription versus a streaming subscription. You can watch your content anywhere you go. And so overall, content consumption is increasing because it's becoming more convenient to consume content. You can watch content on your phone when you're on the bus to school, on the train to school, on the bus or train to work, on a break from work, in the library on campus, where I see a lot of students watching Netflix. And so that's created this overall boom, and streaming has absolutely thrived, and Netflix is one of the biggest beneficiaries. And of course, I'm happy about that because I've had Netflix stock rated as a buy for many years now. And so the stock is soaring, and many of you have benefited as a result of that recommendation, and I'm happy to see its continued success. So Netflix, in its most recently completed quarter, generated 16% revenue growth. And the good news for investors is the company is forecasting 17.3% revenue growth in the upcoming quarter. And if the company hits this target, or anywhere near this target, anything above 15.9, that would be 2 consecutive quarters of accelerating revenue growth. After revenue growth slowed to 12.5% in Q1, it increased to 15.9 in Q2 and up to 17.3 forecasted for Q3. For a company like Netflix to re-accelerate revenue growth is truly exciting. And some of the factors that are fueling the revenue growth is a crackdown on account sharing, an increase in ad-supported services, which many customers are preferring that option when they're joining Netflix. They're using the ad-supported service, which is a lower monthly fee to get access, but then you watch some advertisements. And so that's generating increased signups and increased engagement with Netflix. The management team is forecasting third quarter operating profit margins of 31.5%. And the company, if they hit that target, will be 3 consecutive quarters of operating profit margin above 31%. So they hit 31.7 in Q1, 34.1 in Q2, and forecasting 31.5 in Q3. If they hit this target, I wouldn't be surprised if Netflix increases their operating margin guidance for the full year, because remember, they forecast 29.5% operating margin for the full year, or 30% on a reported basis, not adjusting for foreign exchange. So already in the first 3 quarters of the year, they're well above that 30% margin. And so while the fourth quarter is usually the lowest margin quarter for the company, as you know, it relates to accounting for new content that's coming online, etc. Last year, Q4 operating margin was 22.2%. So this year, if the margin also falls considerably for Q4, they could hit that 30% overall. Or if the management team is very optimistic, they might increase that operating margin guidance for the full year. And that would certainly create upside for Netflix stock if they do indeed increase that margin guidance for the year. One thing that I love about the company also is that they're generating strong cash flow in the billions of dollars now. 2.78 billion in Q1, 2.4 billion in Q2. This is on top of the fact that they're adding a lot of new content to the platform, original content that will forever be on the platform, that will drive benefits for many, many, many years to come. Every new subscriber on the Netflix platform can benefit from content they've added for all of those years. So it makes the platform more attractive for new customers and existing customers as they continue to add new content and benefit from the economies in scale. All that being said, what do I think about the valuation, and should you be buying ahead of earnings? The intrinsic value per share I calculated for Netflix is $1,016. Current market price is $1,200. So accounting for a margin of safety, I could say the stock looks fairly valued at the current market price. Looking at the company's forward price to earnings ratio as measured as I retrieve from fiscal.ai, which is my preferred data source. There's a link in the description if you're interested. You get a free trial. Netflix is trading at a forward PE of 41. So the valuation right now is on the, it's not, I can't say it's expensive, but on a scale of cheap to expensive, it's closer to being expensive than it is to being cheap. But overall, I would more so say it's like fairly valued to being slightly overvalued. And then when you combine that with the fact that surrounding an earnings release, a stock is more volatile, as I talked about earlier, I don't see any urgency to buy Netflix stock ahead of earnings. If I was interested in buying Netflix stock, personally, I would be buying after the earnings release comes out. I would digest the results, and if everything looks okay and everything is the way it is as forecasted, then I would be interested in buying Netflix stock after earnings. I have the stock rated as a buy, so I like the stock at the current market prices. But if I'm trying to time, which I don't usually do, but if I was trying to time it before or after, I would buy the stock after earnings. Hey everyone, so many of you have been asking about my investing strategy, and I'm excited to announce that I've written a book that's available for sale now that describes my 6-step investing framework for evaluating stocks. I've added the link in the description below.